it's certainly been continues to be a dramatic time. I think the main focus actually is not specific to one market. We've got significant moves across equities, rates, FX, and I think importantly yesterday as well, also inflation, which I think could have significant implications. I guess if we just start with equities, and you were talking about the tech sector, but just the broader US equity market in general, I think what's compelling here for us, technically and on a macro basis, is that summer rally, as you were saying, the rally that we saw from June through to August. For us, I think the key thing through that rally that sort of really reinforced the fact that we are in this sort of broader downtrend still is it was a very low volume rally. It was capped pretty much exactly at the key technical resistances you would expect it to be capped at. It was capped at its 200-day average. It's capped at its downtrend for the beginning of the year. And I think importantly through that rally, the volume was just really very light. And we never saw really any improvement in volume through that phase. And then once we rolled over in August, the volume has started to pick up again with the down move. And here we are very quickly back down at the lows for the year. I think for us, we think the market remains in a downtrend as a house. Our house view remains unattractive on equities. Clearly, these lows from earlier in the year are proving a little bit sticky. And it's also the location of some long-term technical support. The 200-week average, the very long-term average for the S&P comes in here as well, around 35.90. So maybe we do get a little bit more sticky sort of holding in here in the near term. But with Q3 earnings coming up, our view is that we will take this 3600, 3590 support level out, and we think the market will continue further down. We have levels we're looking at around 3494, 3500 as our next area. That's essentially the Q1 2020 pre-pandemic high. So it'll be very interesting to see how the market deals with that. But overall, we actually think the risk for the S&P is we actually get down towards the sort of the low 3200 area, which on a long-term basis is a key technical retracement level. I mean, really the whole of the rally in the S&P from the 2009 GFC low. But overall, we still think a fairly negative, unattractive state for the equity market.
David, can I ask you a couple of questions in one, really? One is just to get you to focus on the 10-year Treasury yield and give us a sense of where you think we may start topping out here. And the other is, if you could just mention in passing the seasonals, because I know a lot of technical analyst friends of mine are talking about actually we should be getting towards the end of the traditional weak period for risk on. I wonder if you agree with that, and also give us your line on where we are on 10-year yields.
Sure. I think for us on 10-year yields, we've maintained actually on a sort of 3 to 6 month basis, long-term basis, actually a more of a neutral view on treasuries and on duration. And in the near term, we've actually been looking for this sell-off in treasuries to actually start to sort of stall and for some type of peak to be established. And I think what's been key for that for us, and what we're watching very closely, is actually the inflation break-even picture. And the inflation break-even story has been a key narrative, for inflation itself for markets all year. And clearly, markets in the first half of this year were dominated by, very strongly rising inflation, strongly rising inflation break-evens, and the rate hikes to go along with that. I think what's been really significant over the last few months is inflation break-evens peaked earlier on this year. They've been declining, but if you look at the 10-year US inflation break-even chart, that I think is doing something very significant, and I think it's a very important chart on market to watch. What we're doing is here we're breaking down some really significant support levels. We actually think that's putting in a top for inflation break-evens on a technical basis, and then inflation break-evens will actually fall further.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.